morning, everybody. Uh, Thanks for the organizers for inviting me, and yeah, it's been a last-minute thing, so I've kind of come blind into this, but I'm as eager as all of you to understand more about the opportunities in for the AIF, from the PMS and HNI segment, because my whole career of 25 years in investment management, I dealt only with institutions. So I have worked on alternative investments in the institutional segment, and it'll be a good process of learning for me also to be part of this panel. This is better. Am I still the last benches? Can you hear me? Sure. Okay. As I understand, this panel is about understanding about the investment opportunities out there in the three categories which have been approved by SEBI. What I would like to first do is just pass the mic around and ask everybody to talk about their area of specialization and mention what they think is attractive from their perspective in that particular segment. And then later on we'll take as questions. I have a few questions and I'm sure the audience has a lot more, and we'll try to make it as interactive as possible. Thank you. Let me start with you, Mr. Madhavan. Would you like to go ahead?
So, I'm Madhavan, CEO of Harmony Capital. We are in the category 3 alternative investment fund space. We are running a long-short directional strategies along with certain objective investment strategies being integrated with this. It's an absolute return fund, so we strive to make absolute returns irrespective of whatever happens in the market. Of course. Not audible? Is it okay now? So we are in the category 3 AF space. We are running an absolute return fund, this thing. We are using directional trading strategies, both long short, to get this absolute returns. We are there in this industry for the last 3 years. So we started our operation somewhere in Jan 2013.
Yeah. Can you hear me? Okay, so JLL globally runs LaSalle Investment Management, which is a real estate investment management practice. In India, we run under the JLL Segregated Funds Group, a category 2 real estate fund. Currently, we are out raising our second fund right now, predominantly in the residential real estate sector currently, and we are invested across 4 cities right now in India.
I'm Eric Savage. I run Unitas Capital. We're a social investment bank, so we raise equity and debt for socially impactful companies across a variety of sectors, financial inclusion, affordable education, healthcare, women empowerment, renewable energy, agriculture, those sectors. So our main business is working on behalf of companies, helping them raise capital. We did start our first fund over the course of the last year. That's an offshore fund that invests in companies that create jobs for low-income individuals across Asia. We are actually in the process of setting up an AIF right now for one of our shareholders who's interested in, who's a foreigner actually, who's interested in deploying money. So the regulations that have changed in the last couple of weeks are extremely helpful to him and to us. And certainly I think everything that we do from a more mainstream perspective would be considered alternative investments, because we're investing in companies that have a strong social impact. But in all cases, the investors are targeting a very high financial return, and frankly, in most cases, they're being very successful in doing that. But I do think that this, as the AIF regulation has improved over time, it presents a huge opportunity for people like us, and more broadly for the market, to invest through a new structure. So quite optimistic about this channel being able to be used to invest in impactful companies, many of which are providing extremely high financial returns in addition to really strong social impact.
Good morning. I'm Saravanan from Unify Capital. Unify Capital is a SEBI-registered portfolio manager. We also have an alternative investment fund, Category 3. See, we reckon Category 3 is an excellent platform to do a multitude of investments. And our focus is to generate absolute returns using arbitrage. And I mean arbitrage, it's not the conventional cash futures arbitrage. I also mean the event-related arbitrage thrown by open offers, mergers, delistings, plus fixed income instruments arising from especially emerging NBFCs catering to affordable housing, commercial vehicles, and microfinance. So that's been our focus area. We got our license to do AIF Cat 3 in April 2013, so we're almost 30 months old. And our target is to generate more than 1 unit of post-tax return for every 1 unit of capital that we invest. So which means we are looking at Category 3, as you all know, is a taxable entity in its in the fund itself, and the investors get a tax-free returns. So our endeavor is to generate anywhere between 9 to 11% tax-free returns. It's an open-ended fund with a standard deviation of 5% or less. So that's what we're trying to do.
Thank you, sir. I think that's a good point. So I'll be a little naive here and start, talk a little bit of the overview of this. So, if I can request Mr. Madhavan to talk about, as a HNI, what do you recommend should be the amount of allocation we should make for AIF? Because I know in the institutional segment, universities, endowments, they typically, have about 5% or so of their corpus invested in what they call absolute return strategy. So what is your recommendation as to what an HNI or a family office which is looking deployed well?
I clearly feel it depends on the objective of the respective HNI, but we'd like to have a great share of it definitely. So in terms of approaching hedge funds or funds that operate in the Cat 3 space, there are a lot of possibilities in terms of generating absolute returns, like what Saranyan was specifying. And they are looking at something very different from what we are doing. So you can have a variety of strategies operating in the Cat 3 space itself. That is one of the reasons why the topmost allocation worldwide in the alternative space is in the hedge fund industry. So as I mentioned in my opening speech, 27% of the investments worldwide are going into the hedge fund space. So the reasons being, the strategies being deployed are so varied, it's very difficult to put a particular number to a hedge fund. So my feeling is, depending on the objective of the investor and depending on the needs or depending on what kind of risk return ratio they're looking at, the allocation can increase or be decreased. So suppose Saranyan is targeting somewhere around 9 to 11%. And a risk of 5%. Am I right? So, risk of 5%. So we are somewhere in another spectrum. I mean, another end of the spectrum. We are targeting somewhere around 17 to 19%, and we have gone through a drawdown in the past of around 6%. So, of course, historical drawdown can be much different from what can happen in reality in future. But based on the reward to risk ratio that a particular fund is generating, and based on the actual return that a person is expecting, the allocations can be made. This is my take on what kind of investment that has to come into this. But the real charm here is in generating a nice reward to risk ratio, and that's what will drive investments into a particular fund.
Thank you. Well, what do you think is the possible return and what is the risk profile of the real estate?
Yeah, so real estate is it's a closed-ended fund structure. Normally 5 to 7 years is what you look at. Recently, we have seen a lot of funds being raised with shorter duration, so about maybe 4 to 5 years, which to me is a very risky strategy because real estate, the asset class itself is very illiquid. From the majority of the industry perspective, most people are deploying debt in the hope of making anywhere between 16 to 25% IRR at an investee company level. Those situations might not hold true in the future because interest rates are coming down. NBFCs are competing at the same space with alternate investment funds. It's less tax efficient to do debt in an AIF format, and so on and so forth. And as Shraddha, I think, pointed out, only 50% of the money has been invested out of what has been raised. And I think real estate is a major culprit in that you raise a lot of money, but you're unable to deploy quickly. But I think the way the industry is right now, the market is extremely soft, and therefore that throws opportunities to put equity to work, to actually make an equity bet in real estate. And I think returns in real estate on a higher risk-adjusted basis, should be north of 20% IRR at least. Otherwise, it doesn't make sense. You can probably directly buy real estate on your own. The other, one last point is as an alternate investment fund, you can now secure capital from overseas investors. And I think that's a very reasonable move. It's a very welcome move by most fund managers, because not only throws off a lot of, there's a lot of HNI investment in alternate investments fund in India right now, but there's no institutional participation. So hopefully with this, you have at least NRIs and maybe foreign institutions participating in Indian funds. And that will, further address this ability of fund managers to deploy quickly. So basically, if you don't have the ability to deploy, you will not be able to secure more money in your future funds. So yeah, I mean, that's what I would say.
Eric, your views, and especially since you have a more challenging task, you are looking at a social impact fund. What's your perception of the return, and how did it appeal? You would be in category 2, I guess.
Category 1. There's a social category within category 1. Yeah. So I think that what we've seen, as Aditya had said in the introduction, we've raised about a little more than $1.3 billion since we set up our company in 2008, and a little less than half of that is debt. So on the debt side, all of the debt we've raised has been at normal commercial interest rates here in India, so typically 13–14% or so.
So you raised it from the banks and the NBFCs?
We've raised from banks, NBFCs, and also cross-border NCDs and ECBs from foreign investors as well. Those are the rupee interest rates, 13–14%, and those kind of rates are still available. If you want to take more risk and do sub-debt or do some kind of off-balance sheet or mezzanine structure, there's the ability to get higher 17–18% fixed income returns, but then you're taking subordinated returns. On the equity side, most of the investments we facilitated haven't exited yet, but we have facilitated 28 exits in the last 4 years. And so those exits, the returns have been really good. Actually, the median return is an IRR of 38%. And 3 of them, people have lost money, so they haven't all been good. So none have been total write-offs, but 3 have lost money. But 25 of them have made money, and the median return has been 38%. The average return's been a little bit higher than that because there's a few outliers on the high side. I should add that the statistics are always somewhat misleading, in that in this case where you have exits, you tend to have better returns than in companies where you don't have exits. But I know just yesterday I was in Hyderabad and I was with an investor who we helped make an investment, and they're exiting that now. They're getting a 53% IRR on that. We're actually not facilitating it because the company's doing so well, they don't need an investment bank there. They're doing it directly themselves. So we see those kind of returns are probably unsustainable anywhere. You don't have anyone who's gotten those kind of returns for a 20-year period on, in any sector, in any fund, probably globally. But the companies are growing so quickly in the bottom of the pyramid, it doesn't matter whether it's education or healthcare or financial inclusion, there's just massive growth opportunities. So I do think that there's a very good opportunity to significantly outperform the mainstream markets by investing in companies that are targeting the mass markets.
I mean, what you're saying is quite surprising, because 38% IRR is really a fantastic one, and it really gives the others a run for their money in terms of competing with that kind of returns. But just a little curious, because I've come from the investment side, what has been the usual mode of exits? Because as the previous speaker mentioned, the biggest challenge in India has been getting exits. So what has been the usual mode of exits for these companies?
Yeah, there's been one IPO, but that's not the logical destiny, I think, for most of the companies we work with in the near term. Investors typically invest on, say, a 4 to 6 year time horizon. The vast majority of the exits we've done have been trade sales from, say, Series A investors to Series C investors. And so it's typically when we're helping somebody do a capital raise, there'll be a primary issue for the company, and then alongside that a secondary placement for existing investors. So that's been the main mode of exit, and I frankly expect that will continue to be. There are M&A opportunities, and we're working on multiple M&A situations right now. But I think for companies that are growing really well, most of them still need capital. And so the ability to do a secondary placement alongside a primary placement is a very realistic opportunity in most of the companies we work with.
Mr.
Just Madhavan, could you talk a little more from the investor's perspective as to how do you run these programs? Are they like separate funds, or or is it an open-ended fund which you raise, keep raising money, or how is it happening?
At the moment, we are running one scheme under a Harmony Alternative Investment Fund Trust. The scheme is called Harmony Hedge Fund. It's an open-ended fund. So we propose to stick on to the open-ended side because we would like to give the exit opportunity to our clients on a regular basis. And it is all the more possible from the perspective of our fund because the underlying assets that are being used are exchange traded. So this makes it very easy for
liquid.
much more. It's liquid, and as a matter of principle, we have decided, and as a risk management policy, we've decided not to invest in unlisted securities, even though we are allowed to do so. The fact is, the open-ended thing is possible because of the underlying instruments are in the listed space.
What about you, Mridul? Is there a lock-in in your investment vehicle? Or?
Because it's a closed-ended fund, so you need to have a life of the fund. As I said, 5 to 6 years, or maybe 5-6 years is the average life of the fund. Typical drawdown period for investors are nearly around 3 years or so. Some funds have it less than 3 years. Emerging strategies right now are, as I said, majority of the money that is being deployed, even by domestic investors, is debt, which to me is missing out an opportunity of putting equity to work, but that will change significantly. And most of the exits are actually provided by the project itself, until unless there is a trade sale to another investor or to a later stage investor. Unlike startup funding, these are operating cash flows that you're investing against. So, and if you're able to make 18, 20 or 22% IRR on that, that seems to be okay. So yeah, it's 5 to 6 years.
And the life of the fund would be what, 5 to 6 years?
5 to 6 years. So you don't get capital. I mean, it's a function of the investor class right now, because majority of the investors are high net worth investors and to a certain extent family offices. And I would point out a dichotomy there. Most of the HNI investors who, as you know, AIF, the minimum commitment you need to put is 1 crore and above. So most of the HNI investors are yield hungry and risk averse, if I may use the word. So you tend to come out with strategies which are actually giving out yield, and you're missing on total IRR as an investor, which you don't realize. But when you look at family offices and larger investors, they're actually happy looking at a total return, sacrificing yield. Today the market, real estate, as I said, is quite soft, so there is an opportunity to make higher returns. So 5 years is what you look at, because capital is available only for 5 years, 5-6 years, and that's what most of the funds' lives are. In the recent past, which is, I would say, in 2015, there's some fund managers who've come up with funds which are 3 to 4 years also, with a drawdown period of 1 year. And obviously these are debt strategies. But it's risky. I mean, because if the market is slow at the primary level and you're not able to achieve sales, and I'm talking residential, then it's very difficult servicing debt positions. And therefore, a 3 or 4 year horizon might not be able to do justice to that. But, so the trend is to raise small amounts of money regularly by fund managers, which is basically because the demand is for this product and not in line with what can be deployed successfully.
Saravanan, do you have anything to add?
If you see, I mean, as discerning investors and advisors, you would have observed that equity indices over a longer term perspective, say 15, 20, 30 year perspective, they've delivered a CAGR returns of 15%, but it has been accompanied with the volatility of, say, 25 to 30%. So that's what we are trying to address. So with this, through our AIF open-ended structure, we are creating a investment proposition which gives the investor a consistent returns, but 1/5 of the volatility which is found in the broad indices. So that's what we are trying to do. And it'd be interesting to get some feedback from you. See, for AIF category 3 as well as 1 and 2, the minimum investment size is 1 crore if an investor has to get it. But if you see, say, other platforms, especially PMS, it's only 25 lakhs. So SEBI defines, I mean, has a higher limit because it wants only sophisticated investors who can understand the products and get into such vehicles. So it'll be interesting to get your feedback as to, do you think like even AIF category 3 or 1 and 2, should we even ask SEBI to consider bringing down from 1 crore to 25 lakhs in line with the PMS?
Have any view on that?
See, from is it on? From a strategies point of view, strategists always feel our strategies are sophisticated. But when it comes to SEBI, they look at it as a complexity which is being involved. So it has been looked at as complex because of varied reasons, and we hope that the perspective changes. But from our side, we keep striving to say they are sophisticated, and they can be given to other investors also. But I really doubt whether SEBI will allow 25 lakhs to be an entry level for Cap 3 at least.
Sure. Now, just moving on a little bit to the operation side, and this I'm talking more to the category A and B who have closed-in kind of structures, I guess. So, do you see a challenge in when you approach a retail investor in terms of getting your drawdowns all in place, and how do you kind of ensure it? Because that's I believe in. I've been to my offline conversation with some of my colleagues. I've found, especially from the real estate and other cases, that there have been instances where a certain person has got into a scheme and then not wanted to continue for whatever reason, maybe performance, maybe otherwise. Have you seen any such challenge in terms of accessing money, or you have not come across this, Eric?
We don't yet have functioning in AIF that's taking mass retail money. We do, our fund that we raised, it's a $43 million fund, and we have a lot of HNIs across the world and across Asia who've invested in that, and so we do need to go in and make
So you have
capital
a
calls
manager who
for
does
them.
that for you, administration manager.
Yeah, we do.
Okay.
And if you don't contribute, you get penalized significantly. So everybody contributes.
What about
Yeah, I mean, normally the industry is about 5-7% of whatever you raise. You should actually budget it for the drawdowns not being honored. Specifically, if you have more than 90% HNI investors, or let me say retail investors, we haven't. It is. You can have your contribution agreement which says that you can forfeit the units, you can admit them with a penal interest and all of that. But in reality what happens is it depends on who your distributor was when you distributed the fund, because sometimes the cases are that probably the product has been missold and the gentleman or the lady realizes maybe it's not for them. And in our case, we don't have such a high number. Actually, out of 139 investors in our first fund, I think there are only 3 defaults. And one of them is a legal situation. So in these cases, although you have the ability to forfeit and penalize and everything, what most of the industry does is, after pushing, prodding, nudging, calling, meeting, and doing all the other soft situations, you then kind of provide a solution to the investor where he's really stuck, and you kind of help him or facilitate him sell his position to another investor. And this is very likely to happen if your fund is doing extremely well. In fact, some of the existing investors would like to buy out the other party. On the contrary, if the fund is not doing very well, and there's not too much of cash return during the drawdown period, then it becomes a very sticky situation that you need to deal with legally. But yes, it depends on the distributor, it depends on whether you have the ability to offload that position for that A individual with another individual. It is complex, and it is a challenge for most fund managers.
Yeah, I'm sure.